Hey everyone, this is Anthony Brister with the Wealth Planning Podcast with Brister Law. Today, I have Andres Ledesma again for our second part of our series. If you haven't watched him yet, go watch our first video about risk management. Today, we're going to talk about accumulation and distribution and wealth preservation and kind of how that fits into the process and different stages for people. Andres, how are you doing today?
I'm doing good, man. I'm doing good. Super excited. Thank you for having me on again. Really looking forward to walking through our process and what it looks like with these next stages in the financial planning realm.
Yeah, me too. I'm excited to talk about it. I think this is probably the sexy stuff, at least accumulation, right? That most people, when they think financial planning, that's what they think about, or like to think about. They probably don't like to think about death or risk management too much, but everyone likes rate of returns. Everyone likes talking about investments. I think we'll probably surprise people. We're not going to tell you which stocks to pick today, but we're going to talk about processes, talk about different buckets, talk about different vehicles that you can use during the accumulation and distribution phase of your investing life. So, to get it started, Andres, you have kind of any opening remarks about
Yeah,
last
yeah,
time risk management?
yeah,
And help us transition into the accumulation phase?
yeah. So, as we were talking about in our first conversations about the risk management, the reality is that this should all fit in within your financial plan. So it's not just like one thing, and then we talk about investments. They certainly need to be, something that we piece together for an individual, because everything looks a lot different for a lot of people, right? Some people either have kids or don't have kids. Some people own businesses. So that being said, I think it's very important to understand that this all has to fit in financial plan. There's no one size fits all, and there's not just one product that's going to be the solution, or there's nothing going to save you, right? And I think this is a perfect opportunity for us to talk about it. I mean, it's August 7th today. The markets this week have been pretty crazy. And I think it sheds a little bit of the light of why it's so important to have a plan and not let the noise distract you of what's going on. Because I honestly see this as an opportunity, right? I think, I coach my clients to think that red days in the market they're on sale day, not sales day. Simply meaning that, hey, this is an opportunity for us to invest more of our dollars into the right places to meet our definition of financial success. So yeah, it's a great opportunity for us to talk today about the wealth accumulation, the sexy side of planning, to leading towards okay, we've saved and invested 20, 30, 40 years. We get to retirement, whatever age that is for you. Now, how do we use this, right? And I think it's so important because that phase of planning, especially in the Hispanic, African American, or minority communities, and the reality is every community is not really talked about the distribution phase of planning. All they know is they have a 401k. We may have Social Security, which that's going to be a conversation that I'm not going to get into.
I have my opinion
But
about that.
yeah, and so, but traditionally speaking, the way the retirement system has worked in the past is I like to use this analogy of a three-legged stool. Back in the 50s, 60s, 70s, or 80s, maybe even up until the 90s, but there was three things that your income or your retirement income relied on: a pension, which those are some things that are not really around anymore. We'll have some ideas around how we create our own pension plan. The second thing was a strong Social Security, right? I think that was the biggest thing that we had, and our personal savings. Now that is cut down to maybe just two: our personal savings and a Social Security. There's really no pension plans out there. So now the reason that happened is because the employer shifted the risk back to the employees. And we'll talk a little bit on that and what that all means. But yeah, I think this is going to be a really fun talk. Again, we're not going to recommend what stocks to pick or what strategies, but What we are going to talk about is some ideas around, hey, when we do get to retirement, what does that look like? But also, how do we get there, right? How do we get to that phase? What are some habits, some psychological things we have to think about? Because remember, money is both emotional and it is logical. So we've got to bridge those two gaps together to make sure that we have a plan that defines your success.
Yeah, no, a lot of great things there. I actually did a video earlier this week on Monday when the market dropped. So guys, you want to check that out. Check out my video on what to do when the market's crashing. But really, in summary, just take a breath, stick to your plan, and make sure you have a plan. Secondly, when talking about investing, we're talking about accumulation and also the distribution phase. It really seems like it's a logical thing. It's really just math, right? We just want the highest rate of return and be able to have our money last as long as possible. Um, that seems all good and dandy, but really it's not that simple and it's not logical because we're involved, the human
Mhm.
side of it. And investing money is very emotional for a lot of people. So, if it was just strictly math, it might be different. But really, that emotion side is what causes, I think, a lot of different ways you can plan. And the shoe doesn't fit everybody, right? Or one size doesn't fit all here because everyone's got different emotions, how they feel about it, a different risk tolerance, things like that. So, again, it's really important to have a plan. Talk to somebody who can kind of take some of that emotion out. Because when you're dealing with your own money, you're going to be emotional. But having someone to hold you accountable, just like a coach, right? They can kind of take some of that emotion out, think logically about it, and help you kind of navigate the waters to where your emotions aren't going to be in a wide array or they're a little bit manageable. So, Andres, with that, did you have anything to add? Um,
Yeah, yeah. I think, again, going back to what's going on this week, markets pulled back around 6%. And honestly, that is nothing compared to 2020 when the market tanked 35%, or in 2008 when the markets tanked 55, or in 2000 or 1987. The 6% pullback is not that big logically, right? It's like, oh, it's just something that needs to happen. It's the definition of what's called an efficient market. But the emotional side is like, oh my God, the world's about to end. There's World War III on the horizon, and there's so many things that we think about, or when you're gearing near retirement as well. It's, do you really want to be riding that roller coaster too much? Yes, definitely, as you said, it's not a one size fits all. Your financial plan changes and it's fluid, especially as you go through these stages in life, right? Early on when we're building this foundation, to when our 20s and 30s, when we're building the wealth, and then we get to 50s and 60s, like, okay, now what do we do with all the money that God blessed us with? I think that's so important. So yeah, super excited to talk a little bit about how we get there.
yep. So let's just hop right in and let's talk about accumulation. First off, can you give me kind of what your definition of wealth accumulation is? What age ranges typically are we looking at for accumulation? And then let's go into kind of what that
Yeah.
involves and then go into your process.
Yeah. So to your first question, I think for me the definition of wealth accumulation is very simple. It's how do we make our $1 turn to two or three or four 40 years down the road, 20 years down the road, 30 years, or whatever that means, or whatever your time horizon is. It's really just putting our money to work for us. No one ever got wealthy from just saving. And
Yeah.
that's the truth, right? No one ever got rich from putting money underneath our mattress or putting money in a high yield savings account, right? I think it's more about when you hear about these success stories about people who were successful, they invested in something, whether that be the markets, whether that be their business, whether that be real estate, whatever it may mean to you. That's what wealth accumulation means, is how do we make our money work for us? and give our dollars a job description, right? Our dollars, when we get our monthly paycheck, our dollars are already in a way designated to go to one place or another. Our mortgage, our car notes, our bills, whatever that may be. But we also need to get the psychological portion of this law that says, hey, we know we need to save and invest. We know we need to do more than what we're already doing. I think that's just pretty natural for us as humans. We know we need to be doing things, but a lot of times we don't know how.
Yeah.
So when it comes to the age ranges, I think it really just depends. I think the more traditional way is when you're in your 20s, 30s, 40s, and about maybe till the time you're 55, you really should be thinking about wealth accumulation, right? Wealth accumulation. How do we make these dollars work for us? When we cross over that age 55, and again, this is just a very blanket, very high-level overview. This could change for anybody, but traditionally, at age 55, you start thinking about, okay, now we got to age 55, we may retire by the time we get to 60 or 65 or sometimes maybe even 70. How can we plan for a 30-year retirement? Or honestly, we're also living longer nowadays.
Yeah.
Is how can we plan for the longer periods of time so that we don't run out of money? And when I mean retirement, honestly, I don't like the word retirement.
Me
I
neither.
like the word financial freedom. Financial freedom is just a fancy word of saying, hey, when I get to a certain age, I want to go to work, not because I have to, but because I want to. Right. And so I think that's a good framework to kind of think about in this whole wealth accumulation phase of planning.
Yeah, and, again, said several good things. First off, I wanna touch on the financial freedom portion. I'm also not a big fan of retirement. I used to tell myself, "Hey, I wanna retire by the time I'm 35 or 40-year-old max." But now, as I've started doing this, I started working for myself, I actually am enjoying what I do. Uh, I don't wanna retire. I wanna keep doing it. Now, maybe at some point I slow down, but I think it's really important for your health, especially to have something in your life that's fulfilling a purpose. Now, when you're in a job, a 9 to 5 grind, a corporate job and that you don't like, that's different, but having that financial freedom and the money, the income to support you coming back gives you that option to go out and do what you wanna do. Secondly, you talked about how money typically, if you don't have a designation, it kind of already is designated somewhere. So, if you don't have a plan for your money, I'll tell you who does have a plan is all these companies out here that want you to spend money. Amazon, right? Apple, all these companies, they have a plan for your money. So it's important for you to actually decide because otherwise, you're going to follow their plan and, end up diverting it. So you need to really be conscious about saving and investing and actively put money away. Because otherwise it's gonna go somewhere else.
Yeah, yeah, and that's a good point. And I think one good thing to point out right now is to talk about the disciplines of how should we make our money be designated in a way that we get to define where it's going to go next. And I always say this to my clients, and I tell them, look, I'm probably going to be the first financial advisor to tell you you can go and spend your money. And they're like, wait, what do you mean? What does that even mean, Andres? What are you talking about? And so I think there's a good framework and a good rule of thumb to think about of how to start saving and investing when it comes to your monthly income or your annual income. And the rule of thumb that I like to use is the 50-30-20 rule. The 50-30-20 rule, for most of us, have kind of heard what it is, at least to a certain degree. They kind of have an idea. They know it involves budgeting, but they don't really know what each percentage means. Essentially, the 50-30-20 rule is when we get our monthly income, we separate our money into different categories. The 50% of our income, that's our needs. What do we absolutely need to survive? That includes our mortgage, our car bill, our regular bills, insurances, phone bills, everything that we absolutely need to pay to survive on the 1st or the 30th of every single month. The 30%, this is where I tell people is like, look, we're still humans. we work very hard for our money. Go and spend it. Budget yourself to 30% of your income. And let's say if you're making, we'll do our calculator here pretty quickly. But if you're making $6,000 a month and you save 30% of your income, just to go save, that's about $1,800 a month to go out and spend on whatever you'd like, right? That includes shopping, restaurants, things that you enjoy doing. But the only way that this works, the only way that the 50-30-20 rule works is if you save and invest 20% of your income. Yes, a lot of people say, well, Andres, don't you think that in this case we'll be living paycheck to paycheck? It's like, yeah, absolutely. But you also paid everything you needed. You had fun and you saved for financial freedom. What's more to want, right? And as you said, now, a lot of the times, all of the money that we're bringing in on the monthly basis, yes, it's already designated to go somewhere. Most of us are spending that. But what if we just change that framework and thinking, okay, how do we give our dollars a job description? And so again, that's a rule of thumb for the 50-30-20 rule. I really enjoy it because when people ask, okay, we know we need to save, we know we need to invest, but how much? I usually like to rely, hey, you can't go wrong with saving and investing 20% of your income.
Yeah. I've heard that rule 50-30-20. Where does debt come into play? And, should you maybe modify that if you've got bad debt? And for
Yeah.
those of you guys don't know what good debt, bad debt is, I'll take a moment to explain, and Andres, chime in too if you want. Bad debt to me is any debt that's not income producing. So student loan debt can be good debt or bad debt, depending on the profession you chose. Typically, I like no more than your first annual salary in student loan debt. So for those of you going into school, you want to go be a teacher or something like that, maybe consider not going to Stanford if your first year salary is going to be 30 grand. You're going to have to take 200 grand of student loan debt. To me, that's bad debt. But if you're going to be a lawyer or a doctor, you take out 200,000 and your first year's salary is 400,000, that could be a good debt. Rental real estate, good debt if it's making you money, right? To me, bad debt, very easily identifiable, credit cards, rent to own type of things, anything with a high interest rate that is taking more money out of your pocket.
Yeah, and a good framework for that, it can include that 50-30-20 rule. And guess what? We're going to cut into your fun money, right?
Yeah.
I think when it comes to bad debt, you have to make a sacrifice. Just like anything, you have to sacrifice a little bit. Now, yes, I'm not going to say all of your fun money. Again, you're still human. Go out and spend some of your money on things that you enjoy doing. I like to golf, right? And I like to go hang out with friends and family. And the biggest thing that we have to understand is sometimes those things have to, kind of put it on the back burner a little bit while we pay off these things that are hurting us. And if we go back to our last video that we did in the risk management, debt was a huge part of also making sure that we have a strong foundation. You can go and invest and get great rates of return, but if you have a very high interest debt that is 20% or 30%, the reality is that's just washing itself, right? You're really gaining nothing because it's going from one place to another.
Well, in my case, I would actually say, it's kind of hard to get a 20% plus annual return each and every year.
Yep.
The best rate of returns you can do is paying off credit card debt. That's 20% of interest right back in your pocket, right? That you can take that and save. So definitely, I think, paying off the bad debts, huge and major. And to me, I think having a savings, personally, I think save that money. You can start investing, but again, start looking at that bad debt. You want to get rid of that as quickly as possible, either using the debt snowball or avalanche method. But still, if you don't have any fun, you're not going to make it through it and you're going to get back in the habit. So you still need to reward yourself and celebrate those small victories. But it should be a big focus if you are in bad debt, and talk to somebody about it, come up with a plan of action, have moments to where you're going to celebrate yourself, but really take care of that so you can get ahead. It's really hard to get ahead when you got 20% interest coming at you, um,
Hmm.
just building
Yeah.
up.
And I think that goes into a little bit about compound interest, right? And
Yeah.
compound interest can either work for you or it can work against you. And I think, when it comes to credit card debt is one of the biggest, um, I guess, one of the biggest burdens on Americans today is we go and spend money on our credit cards, and then oftentimes things happen where if we didn't have an emergency fund and let's just say you went on vacation, you charge it on the credit card, and hey, it's going to be all good because life's not going to happen to us. We'll just pay it off next month. And the next month happens, and then your tire, need a new tire replaced, or something happens in your house or your car, and now you're like, oh my God, I don't have an emergency fund. Swipe that credit card again, right? And so I think it's very important to have some discipline around that too, and it's very hard, guys. I mean, it's something that a lot of people struggle with, and that's just the truth. I talk to hundreds of people a year, and just about everyone has some debt attached to them. Again, good or bad, and there's nothing wrong with that, but it's just what we do with our money. And going back to that 20%, or even cutting into your fund money, the idea behind it is try to pay off your debt as quick as possible. Try to make compound interest start working for you again, not against you. And that's going to, one, psychologically and emotionally, you're going to feel so much better because you don't have the banks dangling over your head, right? Thinking about, oh God, I've got to pay this. But yeah, so those are definitely some good points. I think the next conversations we should also talk a little bit about some debt management and some methods. I think would be really cool for people to hear about that. But going back to why we're here today, I think last time I ended the podcast saying, everything that you know about retirement planning is wrong. And that was a pretty hot take, right? It was
Yeah.
like, okay, what did you mean by that, right? Here is what we know. I guess most Americans know when it comes to saving and investing and retirement planning. Hey, go find a good job, invest inside your 401k every single month, and then that's it, right? And then you get to retirement. Now what, right? What I mean by everything that you know about retirement income planning is wrong is thinking about the income piece of planning. Everyone thinks that the investments and everything that we do from the wealth accumulation phase is just going to seamlessly just happen in retirement, and we're just going to take the 4%, every single year. And just by the way, math can prove you wrong that that's the least efficient way, saving and investing. What's that term called? I even forget about it because I never use it. Save it, buy term, and invest the rest kind of difference. I think that's
Yeah.
what it's called. There's a lot of white papers that talk a little bit about why that's wrong, and just the investment side. If you just do the investment with no other tools that are attached to it, like creating your own pension plan for guaranteed retirement income throughout your retirement, or even sequence of return risk, which we'll talk a little bit about what that means. But for the most part, I think it's retirement planning is not what you think. It's not just save and invest in a 401k and then it'll work out in retirement. And so we'll have some pieces to show you guys today about what that looks like in some real life scenarios. But yeah, no, I think this is going to be really fun.
Yeah. And guys, again, I think a 401k is good and dandy, same thing with a Roth, but that shouldn't be the only piece in your financial plan. Uh, Especially for you business owners out there, lack of control, and you can't control the market all the time. So it's good to have something that's not correlated to the market. And we're going to talk about sequence of return risk, but something that's not correlated to the market uh, is really diversifying. Most people think they're diversified by putting money into an ETF, right, that follows S&P 500, or they buy different stocks, but that's all an asset class, and an asset class can be affected by market events, just like you saw this Monday, where there was a big downturn, just because of Japanese yen, Japanese interest rates caused the whole market to drop. Um, Even if you're in S&P 500 or maybe one stock in particular, you probably saw a decent sized stock drop. So again, using different asset classes, I think, is important, and that's really what diversification is. So, Andres, let's talk about accumulation. Talked about kind of the bad debt stuff. Don't want to go on another tangent on that, even though we could probably have a whole another episode about it. Um, what are the kind of things that we need to be doing during accumulation? Uh, what are some vehicles, and kind of what is your
Yeah.
process?
Yeah. So that's a very good question, because when we think about wealth accumulation, there's so many things out there, so many vehicles, and so many baskets of money, is what I like to call them, or buckets of money that are out there that we can invest in. One of the biggest things that's a very low hanging fruit for everyone is your 401k that your employer provides for you. That is the most efficient way for you to systematically get money withdrawn every single month from your paycheck pre-tax to go invest inside of the 401k. And oftentimes you get a match, right? If you're not investing up to your match, like let's say 4%, then you should be. That is an instant 100% rate of return, just like that. Let's just say, for easy math, you put in 100, your employer gives 100, it's now $200. It's pretty straightforward, right?
Well, you got some taxes on there too,
That too, that too,
but
that too, yes.
again, I won't give away free money. So, I do think that that is a good starting place. And actually, there's a new law that came into effect this year where some employers are actually matching what you pay off your student loans too. So,
Mhm.
you got a big corporate job, ask about that, and maybe if you're not able to save and invest and you're paying off debt, you might be able to still get that match. So,
Yeah,
don't
yeah.
pass up that opportunity.
Yeah, and going back to the match, I think when you think about anything above the match, like let's say your company matches you 5 and you invest 6% or 7%, I really think that there's other vehicles out there when we think about taxes, like Roth IRAs, or Roth 401ks, that you could be putting that excess 2% into other vehicles to get it out of the tax code, right? Or the view of the IRS. For most of you that don't know what a 401k does, essentially you're putting money in pre-tax, money that hasn't been taxed yet. You're putting in 5% every single month till, again, let's just say you retire. And then when it comes to age 59 and a half, and I really wish they would just say 60, I'm sure there's a reason why, you maybe know why, but I honestly don't know why it's 59 and a half, but you can't touch this money until you're 59 and a half. Let's just call it 60. By the time you're 60, let's say right now I'm 28, 30 years from now, when I turn 59 and a half or whenever that is, the biggest question that I ask myself, and the biggest thing that retirees are worried about today as well, is where are taxes going to be? What's the market going to do? And we'll talk a little bit about secrets of return risk, taxes, and health, right? I think I mentioned taxes 2 times there, but again, that's probably the reason why I mentioned taxes, because when you are contributing to your 401k, when you get to 59 and a half, any money that you start distributing is going to be taxed, because that dollar has not been taxed yet. And so I always tell people that, yes, go ahead and get your match, but don't put more into it yet until we start looking at other vehicles like Roth IRAs, maybe even brokerage accounts, things that are not as tax liable for you. And as we mentioned last time, your biggest bill that you're going to get in your entire life is going to be taxes. And I'll leave you do that. But one of the low hanging fruits is just, yeah, contributing to your 401k. But what else do we do after that, right? And that's just when we talk about that 20% rule. Let's say if you are, you have that 5% match and you are making, that $6,000 a month. That $6,000 a month at the 5% match is, $300 that you're already doing, right? It's $300 that you're already doing. So when you look at the scope of the 20% rule in this in a $6,000 monthly income, 20% of that is 1,200. You take away the $300 that you're already putting into your 401k. So now you've got $900
Yeah.
to go out and distribute elsewhere, right? And not just into one vehicle, and we'll talk about that, but there's other vehicles, and I'll share my screen here in a bit to talk about the different vehicles. And maybe it's a good time for me to do that, to kind of give people an idea. What do you
Yeah,
think?
I think, yeah, let me just say something real quick too. I think again, it's important to note that this isn't one size fits all. Uh, Personally, to me, I'm in favor. If you got the match, get the match. I like control. I'm a business owner, and I think that I can go out and invest in my business or other uh,
Hmm.
mechanisms and go get a better rate of return by having that control. But some people do not want any control. They're scared of, taking control of their finances. So, things like the 401k or Roth, that are a little bit more passive might be the better tool. So again, this isn't one size fits all. We're just talking generally here. But,
Hmm.
uh, I do think getting that match is a good starting place. And then from there, speaking with someone, coming up with a plan and figuring out what works best to allocate those other dollars. And when we're talking about the 50-30-20 rule, again, what are we gonna do with that excess in the 20 after we're doing that?
Yeah, and I think it's so important, just as you mentioned, when you think about retirement income planning and what you should be saving in. There's so many questions that you want to think about in retirement. Like one of the biggest things is again the emotional side. When you're 30, 40 down the road, it's like, what do you want life to look like then? Do you want to travel a lot? Are you probably going to have grandkids at that point? How do you feel about that, right? Or do you want to save and invest for them too, or like for your grandkids at that point? Do we need to make a budget? Do we need to account for Social Security? So there's so many things that we also have to think about. It's not all about rates of return, right? I think the rate of return is just one minuscule piece of us getting to from point A to point B in retirement. But we also like to think about retirement planning and the emotional aspect of it all. What does life look like? How's my health going to be? All of those things that come into play are also a factor of when we build this retirement income plan. So as we were mentioning, the low-hanging fruit being that 401k. As a business owner as well, there's also tools out there that you can, put into place like SEP IRA, solo 401ks that help you reduce that tax burden today. Again, you're reducing tax burden today, but you're not, eliminating it. You're going to have to pay taxes on that, 30, 40 years in a row. So we have to be a little bit strategic around there. But if there's a pain point there where taxes are a little bit higher for you as a business owner, there's retirement accounts that you can put into place for yourself. Again, if because your business is going to be your home run, right? Your business and going back and investing back, that's where you're going to make your most money. But when we think about tax planning today, is also okay. Let's take a step back. Would I rather give and pay myself money from left pocket into the right pocket and worry about taxes later in life, or just go ahead and pay that tax bill today to Uncle Sam, right? And I think that's a partnership that we also have to keep in mind is, the partnership that you have with Uncle Sam. That's not probably a partnership that I really favor a lot, but as you think about the different aspects of what you should be investing in, it really just, I guess, to go back, it depends on what you want your life to look like, right? What does life look like for you? Do you want control? Do you just feel more comfortable with a systematic plan? And that's what we help our clients with, and I think you do as well, Anthony. Is we walk into is like what we may think that you need is not what you want, so we help our clients develop a plan to think about what it means to them. And so, that being said, what else do you think we should touch on, Anthony?
No, I think that's a good transition. You can go ahead and share your screen and let's talk about these different vehicles and avenues that we can take.
Yeah, absolutely. So we'll talk about this. I'm a little ahead, but I love this page. This page is one of my favorites to show to all of my clients because when you think about that 50-30-20 rule and you think about, okay, I know that I've paid my needs, I know that I had fun with my wants. Now what do I need to do with my money? So I'll draw on my screen a little bit, and bear with me, guys, because I know that this may be ugly because I don't have my iPad with me. But when you look at saving and investing, there's so many things out there to invest in, but they all have the same common goal. In this case, retirement income or financial freedom income. Again, we're mostly talking about the most traditional way, which is, working for 20, 30 years, then we're saving and then taking that accumulation phase of planning, of taking money from, in this case, either 401ks or whatever it may be for you. But what this page shows us is showing clients where is all of our money going to be in. So you'll notice that you have this income bucket that's a little bit higher than the rest, right? And there's a reason for that. There's that income word there. So all of the money that we bring in on a monthly basis goes through this funnel. The rest of the funnel then feeds, the different buckets of money that we put our money aside for in the future. Each one means a lot of different things. So you have like your Roth, your qualified account, non-qualified, and deferred annuities. We'll talk a little bit about what that looks like. But your Roth is simpler. We already know what it is, right? It's a Roth IRA. We'll talk about why that's important. Qualified account, just a fancy word of saying, hey, it's qualified for retirement, is one of the easiest.
Yeah, what does that mean what's the difference with Roth and qualified accounts?
Yeah, so a Roth IRA is going to, essentially what it does is you put money inside of a Roth IRA account. It's money that's already been taxed. So you've already gotten paid. It hits your bank account. You've already paid your withholding taxes and everything you need to pay for. And this is after tax dollars that are going into this bucket of money. So it's after tax, already been taxed. It's going to grow tax deferred. And then it's going to, whenever you take money out, it's going to be tax free. The reason I say it's tax deferred is because that's the legal way to say it. It grows tax free, goes in tax free, grows tax free, and you take it out tax free. So that's one way that you can think about Roth. Qualified account is just as we were talking about in a 401k. It's money that goes in pre-tax, meaning that it hasn't been taxed yet by Uncle Sam. It's going to grow tax deferred, and that's important because, again, you're deferring taxes until you take this money out. And then when you get to retirement, or to age 59.5 in this case, it's going to be taxed. So that's the main difference. Essentially, the easiest way is one's going to be taxed and one isn't. And in the Roth, there's also things called like a Roth 401k, which are kind of coming in a little bit more in the big corporate world. So, that also falls into this bucket here. Non-qualified is essentially, think about like your brokerage account. Think about your Robinhood or, things that you just trade either on, that have no age limits. It's not really meant for retirement. But you've also got to think about taxes here. Short-term capital gains, long-term capital gains, and I'll let you talk on that, Anthony. And we'll also talk about deferred annuities. Now, this is not something that we're going to really focus on today because it doesn't really fit into our conversation, but we're going to talk about it just as a, as a hypothetical of where it can fit in. But essentially, the reason why I wanted to show this is because our money that we're bringing in on a monthly basis, whether it be pre-tax or after-tax, whatever it may be, is going to be designated into different buckets of money. Now, going back to our first conversation of protecting our income, you'll notice, again, that this is higher than the rest because it feeds everything else. If you're not protecting your income, then none of this works. Right? And so that's why, again, going back to the importance of why we think about risk management and why it's so important is because of those things. But when you think about different buckets of money for folks, this is going to be the piece where I show clients, hey, there's just not your 401k, there's Roths, there's not brokerage accounts, there's other qualified accounts like 403bs when you're a teacher. But all of these work for one funnel that we take out. And this becomes essentially when you distribute money from these buckets, right, it becomes into cash. Again, we're not going to talk about the tax perspective of this all, but we turn this into cash, and then this cash turns into our retirement income, right? And so when we're taking distributions in retirement, we're leveraging different funnels for different purposes, right? And we'll talk a little bit about what these other buckets of money mean as well on the left and the right side, like the base income and the cash reserves, and where those fit in. But just in the aspect of this conversation, that's where our retirement income is going to come from. It's not going to come just from one place. And it's not just going to come from a 401k when you work with a professional. And it's not just going to be one thing like a life insurance policy, right? It's going to be a lot of different accounts that are working for the same goal, which again is that financial freedom. It is that retirement income. But what other questions come from this, Anthony? What do you think I missed?
Yeah, I think one thing that I don't see on there, which may not qualify for everyone, but medical expenses are a huge thing, and I am a huge fan of HSAs, or if
Mm.
you don't have that high deductible plan, FSA, or if you're a business owner, a medical reimbursement plan or health reimbursement arrangement. I've heard both terms there. Where does that fit in? And
Yeah, I think that fits into the risk management because the primary purpose of those is for that risk, and that includes like health insurance, right? When we talked about that risk management,
yep,
flexible savings accounts, health savings account, and we'll talk about the HSAs. Those are something that are super cool that a lot of people miss. But just in the more traditional aspect, I think that's where that fits in for sure.
okay.
But HSAs could be something that we could add on here because essentially what it is you put in money after tax, right? And it's essentially for qualified expenses. But I think there's a 3,000 limit for this year, right? If I'm not wrong.
So you can actually do, I believe, 4,150, and if you're
Okay.
married, up to 8,300.
Yeah.
And you get a tax deduction for that.
Mm. Yeah. So tell us a little bit about those tax components.
Yeah, so people call it triple tax threat,
Mm.
but I mean, honestly, what it does is kind of the best of both worlds of 401k versus Roth, but to be used for medical. So when you put money in, you have to have a high deductible plan and an HSA. So if you've got the high deductible plan, you can put money in, you get a tax deduction, just like if you were to put money in a 401k, right? Except now, if you take that money out for qualified medical expenses, it's tax free. And also, that money can grow. You can invest it in stocks. You can also self-direct it, which most people don't know. So if you're a real estate investor, alternative assets, you can actually invest in your HSA with those too. That money earns tax-free or tax deferred depending on how you use it. So just like a Roth, if you use it for qualified expenses, that all comes out tax-free. Now, if you wait until retirement age, you can actually pull the money out just like a 401k and be taxed on it as if it's a 401k. If it isn't for medical expenses, I typically don't recommend that. But if you do need the money come retirement age, that's available. Most people, once they reach retirement age, their medical bills, whether it's Medicaid premiums or Medicare premiums, things like that, health insurance, whatever, you're going to have high medical costs. So use that HSA to fund those. But in the meantime, you can grow it, get tax-free earnings on it. As long as you use it for qualified medical expenses, that comes out tax-free.
Yeah, yeah, and those are something that are super cool that traditionally most of the times they have to be locked away and then they have to be used for those certain expenses. But I think it's really cool that if you don't use it, that you're still able to use it into a different light, a couple years down the road whenever you do want to use it. But going back to the retirement income planning, there's also this other side, which is the left side, which is we think about just the base income. The base income in retirement is going to be things like, an annuity income, which again, an annuity, for those that don't know, is essentially traditionally it's an insurance contract. That insurance contract, you put a lump sum of money in, and that lump sum of money is going to base out a payout ratio based off of your age and other factors. I'm not going to get too technical with it, but essentially guaranteed income for the rest of your life. We'll talk about where those fit in. Not really a huge conversation for today, but it's definitely going to be a topic that people need to realize, because one of the biggest fears that Americans are facing today is the worry about running out of money in retirement. An annuity income can serve as a base for your retirement income planning that is going to be a really great fit for people in retirement. So again, this is mostly talking about when we do get to retirement, what do we want to make sure that no matter what happens, we have money coming in the door. And we also think about Social Security. Again,
Yeah, I wanted
going
to
back.
say something too, a little bit just on annuity income, because I think annuities get a lot of bad rep uh, when they shouldn't, because people aren't thinking about what they're used for. Anytime you're working with an insurance company, what insurance companies do is they spread risk and mitigate risk. So when you're thinking about annuities, um, the risk that most of these insurance companies are taking is giving you a guaranteed income of some sort or a guaranteed return, right? And so they're taking that risk off your plate of running out of money or, sequence of returns risk, whatever it might be there. Um, in return, they're taking premiums and, the whole goal. An insurance company's not going to stay in business if they're not making money. So they're going to go out and take on those risks and keep the spread. So an annuity can be a really good tool to build up that base income. Again, you might not go out and get the highest rate of return, but you're taking less risk and you're shifting that risk over to the insurance company by doing that. So again, I think annuities get a bad rep because they're comparing it to the market when it's a different tool completely.
Yeah.
So, I think that's a good start on annuities. And guys, if you want to learn more, reach out to Andres about it. But uh, don't just shun off annuities because they can be a good tool for retirement.
Yeah. I think there's a really important word that a lot of people forget about when it comes to insurance, and especially when it comes to life or annuities, is that it's a contract. It's a contract between you and the insurance carrier. What insurance companies do with those premiums is they go and set it into their general account, which every major mutual company, and I like the word mutual because it really means that whenever you partner with these mutual companies, your policy as a policy holder, you're also an owner of the company, are entitled to profits. Not entitled, but that's the idea behind it.
Mhm.
But an annuity income contract, it's a contract that, hey, if we put X dollars in, the insurance company is going to promise X, and what they're going to do with their money is they're going to go and invest it in their general account, which is, there's a lot of long-term bonds, a lot of private equity things that they're dealing with, and insurance carriers are probably some of the best investors in the world, right? They have hundreds of years of data, especially the companies that have been around for 150, 160 years. So again, one important word there is a contract. So again, and that'll be a topic that we can talk about. Annuities can be complex, but they also get a bad rep because of the way that they're sold by some people. People, just by the way, I don't think that if you have an old 401k, you should roll it over into an annuity, especially a fixed index annuity very early on. There's a lot of folks out there that, that don't carry any securities licenses that are going to sell you a fixed index annuity as a 401k alternative because they don't know what else to do. And the reality is they're hurting the client more than they are. But that's a different conversation for a different day. But going back to the base income, we talk about, the annuity income to build a base. You got the Social Security, which again, going back to, hey, back, 30, 40 years ago, we did have a strong Social Security fund. Today, not so much. Now, there's some sayings that when 2033 or 2034 comes around that fund is going to run out. I don't think that it will, but I do think that payouts will be decreased. So that can be a topic that we talk about as well. But that's so important to talk about now because you should not be relying on Social Security for retirement, right? And I wanted to mention that because it's a lot of people think that they're going to rely on that. But man, have I seen so many people struggle because they've relied on that Social Security payment. And honestly, it was probably one of I hate to say it's one of the worst things that you could do to yourself if you're just relying on Social Security income.
Yeah, and I think it goes back to control for me. You're putting your control into the government, which, I probably have a different opinion than most, but I don't think that they do a very good job of controlling money. They've got a spending problem, just like most of Americans do. Uh, but there's a problem with Social Security. Go read the Social Security reports. I mean, they say it in there, and that's public information. At some point, something's got to give. Um, there's been tons of solutions thrown around, whether it's needs based testing or reducing that benefit. I agree with you. I don't think that they're going to get rid of it completely. That'd just be political suicide. But I
Yep,
do
I say that
think
word all the time. Yep,
I
I think
do
it'll be
think
political
something's got to
suicide.
do. Yep, yep.
Yeah.
So.
And then, just to hone in on these next topics too, the pension, that's not something we're going to talk about today too much because they're not really around anymore. It's mostly like the pensions that I do see right now are people like in the police force or in the government space. It's not something that is so common now, but it used to be, a place where, hey, that's the base income. But again, you'll notice here that it's a base income. There's also a desired income, right? What do you want your retirement to look like? Do you want somebody else to have a say on what your retirement looks like, or is there something? And so when we look at the desired income in retirement to our base income and we subtract that, then we have that income gap. And the way that we resolve for this income gap is for this, with the deferred annuities, non-qualified accounts, qualified accounts, and Roth accounts. Money that, hey, different buckets of money that are going to be invested. They're treated differently from the tax perspective. It's honestly the biggest difference there in between all these accounts, because all these accounts here are market, except for this one. Maybe we could talk about variable annuities, but we're not going to talk about too much about them. Most of these are related with the market. They're market correlated assets. So the biggest thing that we talk about now is that, okay, what is another risk that we have to think about in retirement? And as we mentioned earlier, is a sequence of return risk. Well, Andres, what does that mean? And Anthony, I think you have a really good definition about what sequence of return risk is. Can you share a little bit with us what that means in the most simplest form?
So, you put me on the spot here, but the way I think of sequence of return risk is at any given moment in time, depending on what the return is, you can have the same average rate of return. So let's call it a 7% return. But depending on the number you get in each year, you can have a different outcome. So if you start out at a negative 20% return, but average a 7% return over 20 years versus someone who gets 7% every single year with no drops, you're going to have two completely wildly different outcomes. And, the way the market works is it's not linear and it's not the average rate of return. Some years you have a high return, some years you have a negative return, or you might have a lower return one year and a higher return the next year. And being in the bull market that we've just been in, a lot of people are used to these big returns each year, and now we're starting to see some volatility, things like that. So to me, sequence of returns risk is the rate of return that you get and the order that you get it makes a difference in the outcome.
Yeah, yeah, and to keep it just very simple, it's the order and the timing of the investment and what that looks like, right? And that's so important because we don't know when we're going to retire. We have an idea, we have a projection of when we want to, but going back again, and we'll have some data on this next slide. But in 2020, if you were to retire in 2021 or 2020, I think the market tanked 35% overnight. Imagine what that did to your account, right? And so we'll show a little bit of some numbers, but essentially it's just the order and the time of the investment, and can significantly impact the value of your overall portfolio. And we want to make sure that we keep that in mind. So one of the biggest things that we implement for our clients when it comes to retirement income planning is this cash reserve. Cash reserves has a lot of different meanings, but essentially the way that I like to think about it is money that is set aside as a safety net for our overall portfolio. Yes, sequence of return risk and liquidity and opportunity risks that come with it all. We want to make sure that we have a safety net for this for this big portfolio that we've been working on for years, and essentially think of it now, it's to some portions it is insurance, but it's insurance on your portfolio, on your retirement income, what that looks like. So when I think about cash reserve is, and I'll draw this here, so bear with me if it's a little bit ugly, but when we think about the stock market, it looks something like this, right? It's going up and down and up and down, and then like up, 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 and then all of a sudden it goes down, and then it goes back up, and it kind of looks like that, right? It looks like a bunch of staircases and a bunch of hills and mountains. But when you step back and you look at it, essentially, it's always going up. The markets will always come back. Now, I will say that with an asterisk, but history and data shows us that the markets do recover. But what happens when you are in retirement and then you get these bumps here? Those are so huge, because it only takes about 3 or 4 down markets for you to have a very significant impact on your portfolio based on the data that I'm about to show you guys. That's what we think about when we think about cash reserve. Is what do we do with these market-based accounts? What if we just shut these buckets of money off and we start pulling money from our cash reserve when the markets go down here? Right? And those included in our cash reserve are going to be money market accounts, CDs, short-term, mid-term bonds, the cash value of life insurance. Some other people like to do reverse mortgages. Annuities also coming into a cash reserve here, by the way. So that's why I don't want to talk about it too much on this side. But an annuity can also serve as a buffer asset, the end asset. Shout out to Caleb Williams, the end asset to it all, to your portfolio. And so I'll stop there because we're going to go to this next slide and talk about the actual numbers of a case study. But Anthony, what are your thoughts so far on this page?
Yeah, no, I mean, I think that's good. Having that cash reserve or that buffer, right? Might not just be cash, but having that buffer is good, because what happens is if you take it out at a loss, you're actually compounding those losses versus, taking it off in a higher year. So I think that's where you kind of get these sequence of returns risk and why it makes a big difference. So let's just jump right into your case study and kind of show the audience what this.
So what this example is a 20-year performance of a traditional IRA taking annual distributions systematically from 2001 to 2020. Now, the reason I'm showing 2001 to 2020 is because I can't show you what's going to happen 20, 30 years down the road, but we do have data that backs up what the market did based off of a 60-40 portfolio. A 60-40 portfolio, for those who don't know, essentially it's 60% of it being in stocks, 40% of it being in bonds. A lot of people say that that's a very balanced portfolio. When market goes down, the bonds are there to save us. I would tell you that doesn't always work that way, especially what happened a year or two ago when both the stock market and the bond market were down. That has never happened before, and it's weird to say that a lot of things that have never happened before are starting to happen now. So I think that should be something as well that you want to think about for your own retirement income plan. But essentially what we're doing here from your portfolio is taking $60,000 a year every single year, increasing 2.1% for inflation. Okay, so going back, imagine this is Anthony. Anthony is 65 years old. He's heading into retirement. He's got $1 million in his traditional IRA account. Now, I'm not going to talk about the tax portion of this, but that's one thing as well as we also think about it. In a traditional IRA, you are going to be taxed on any money that comes out, but let's just worry about the whole numbers here. So when we look, you start taking distributions from $1 million portfolio in 2001. The market return that year in a 60-40 portfolio, -3, let's just call it -4%. You took out $60,000, balance in the year is $904,000. Well, a lot of people say, well, Andreas, we only took $60,000 out. Why is it not $940,000? Well, because the market had a -4% that year. Okay. The next year, age 66, the market did -9% in 2002. Your beginning balance was $904. This year, adjusted to inflation, we took $61,000 out. The balance now is $766,000. that's when people start opening their eyes, like, okay, the market has a big say in what happens to my overall balance. But then we come back here, the following year, the market returned, let's just call it 19%. Beginning balance was 766. You took out 62,000 this year, but then the market went up to 836,000. So we're happy that year, right? And then the next couple of years, we're also happy because, hey, we took 65,000 out and there's still some money in the account, right? There's still money that we can withdraw. But then 2008 happened. 2008, if you were in an all equity or an all S&P 500 portfolio, this hit was probably close to around 40 to 55%. But because you had a 60-40 portfolio, when we think about building a plan, we also think about asset allocation and asset location. But the negative 20%, look at what it did here. The beginning balance was 794. You took out $69,000 that year. Again, we're adjusting to inflation every single year. And then that account is 579,000. Doesn't feel too good that year, right? We're not feeling too great. We're 72 years old. A lot of people are thinking, can we go back to work at that point? The reality is we don't know. How is your health during this time frame? So I'll let you go because I know you want to say something.
Yeah, something too in particular about that age, guys, and we're talking about traditional IRAs is required minimum distributions. So up until this point, you've got an option where you don't have to take out money if you don't need it. But really, after that 72, 73, you have RMDs. You're forced to take it out. And if you don't take out that RMD, you get hit with a 50% penalty. So, up until those years before, you kind of had some little control over, can I take this out? Or, maybe I go get a side hustle to kind of help mitigate how much I take out. After that, if you're in a traditional IRA, you have to take out those distributions. So,
Yeah.
I think that's something important just to think about and not really depicted there. But if you have those bad years again, starting after that, it also could make a big risk and you're now forced to do it. So just one benefit of diversifying your buckets. But
Yeah.
we,
The
that's
asset
all I'm gonna
location.
say there.
Asset location is also important.
Yep.
And actually, this next slide will show RMDs because of the way that we're taking distributions. But after 2008, we essentially have a pretty good bull run, right? That's what we call it. This negative 2%, yeah, like it sucks a little bit, but it's not really too big because look at how many years of returns we got. But every single year, remember, we're taking 60,000 adjusted to inflation. By the time you're 84 years old, you need to take out $89,000. You've got $89,000 left in your account. At age 84, you have $89,000 left. Anthony, if this was you at age 85, how do you feel?
Well, I'd be hoping that they raise taxes so they could support Social Security because that's what I'm going to be relying on at that point. I wouldn't feel
Absolutely.
too good.
Absolutely. But here's one thing that doesn't show on this. 2021. 2021 happened. Let's call it on a 60-40 portfolio. There was a negative 15 drawdown. Negative 15% out of 89,000 is close to like around 65 or 70. You're out of money by the time you're 85 years old. Because when this account hits zero, it's gone. There's no coming back from it.
Yep.
So when we think about when we talk to clients, when we think about retirement income planning, we think about the risks that are happening in the market. Now, we can also talk about, well, Andres, instead of a 60-40 portfolio, maybe we could just go all in cash. You're running out of cash by the time you're, I guess 10 years in, maybe, if you're all in cash. Or if you just have a bond portfolio, again, this is based off of the market doing pretty good and rely on the market because you need the market to do well. But how do we take away that? How do we take away the market from being the only thing that we rely on? And this is called systematic distributions. But what if we changed one thing? What if we only changed one thing into your overall retirement income planning? And essentially, this is the exact same thing. So I'm not going to go through this full thing because it's the exact same rates of return. We all start with a $1 million portfolio, a 60-40 plan. And every single year, we're adjusting our distribution with inflation at 2.1%. The only thing that changed is when the markets were down, and here's your fancy word of RMDs here that we'll talk about. But when the markets were down, instead of us touching our market-based accounts, what if we just took money from our cash reserve, like annuities, money markets, CDs or bonds or cash value life insurance, whatever it may look like. And mostly when I'm thinking about cash value life insurance, I'm talking about whole life. I'm not talking about IUL. I have my own thoughts about IUL that we can talk about. I think that would be a good topic for us to have on here. But we're talking about whole life, something that is guaranteed to be there in retirement. And the word guaranteed is something that I don't take lightly, because guaranteed is not a word that we throw around in our industry very, very easily. But I can, with confidence, say that in a cash value life insurance, there are guarantees attached to it where you know that money's going to be there. And this is where we could use that money. Again, it doesn't have to be cash value life insurance. It could also be money markets or CDs. But what if, instead of us taking money from our market-based accounts when the markets are down, we take money, and again, RMDs here because we have to take RMDs to satisfy the government here, but we take money from our cash reserve. And again, what does that look like by the time you're age 85? At the time you're 85, Anthony, because you changed one thing in your overall retirement income plan, you're left with $1 million, $1,008,000. You're 85. How do you feel at this point?
Feel pretty good. I was just wondering here, Andres, where does the cash reserve fit into the total balance here? Um, and I guess you said we're using whole life here as a reserve.
Yeah, in this case, we're using the whole life as a cash reserve. Where this fits in is also, again, we're just talking about the cash value component, and there's actually a lot of research and math done that if you use whole life as a bond alternative in your overall portfolio, it actually generates better yield than a bond portfolio, but we won't get too much into that. But where this fits in that cash reserve is, again, instead of taking money from our traditional IRA, we take money from our cash reserve. And again, cash reserve can be a lot of different things. But when the markets go down, we touch our cash reserve instead of and letting our markets account recover. Because remember, if you go back here, by the time you get to start touching your traditional IRA account, it's at $1,055,000. And the other account, you were down $700,000 to $700,000. That's what we mean by sequence of return risk as well, is what happens during those down years. What can we do different to avoid those? So hopefully I was able to answer that question, but that's where that fits in, is in retirement, when markets go down, what can we do to mitigate the risk of running out of money? Because when we're in retirement, you can't get a loan for retirement. You can't go down to Bank of America and say, hey, I need $1 million because I need to retire, right? That's based off of Social Security, again, could be something that is strong, or again, we have our thought that it may be weak by the time most of us get to retirement. But what if we just change one thing, right, into all of this? So when we look here, there's a difference. By changing one thing, it's a $900,000 difference. So I tell people, hey, you've got client A, you've got client B. Anthony, which one would you rather be?
Yeah, I'd rather be the one with more money in my bank account.
And usually that's a layup question, right? It's a layup question because a lot of the people say, like, yeah, I want to be that. But when we go back to when the cash reserve needs to be implemented, we'll talk about that. It's really almost got to be timed in the right way. When we look at that 20%, there's a study out there by EY, which is Ernst & Young. It's a big four company when it comes to accounting, and Anthony can talk about their reputation. These guys don't just put things out there for no reason, right? When they put out research, it means that it works. whenever you look at the EY study, maybe we can link that in the description below of what that looks like. But what it says is when you integrate annuities and permanent life insurance into your overall retirement income plan, your probability of success rises compared to just an equity and bond portfolio in retirement, which is traditionally what we're taught, right? We're taught to invest in our 401k. We're taught to just do that and get to retirement. But when we get to retirement, now what, right? There's so many studies out there as well that show that the 4% rule is not the most efficient way. We go back to talking, maybe even the Dave Ramsey conversation that was out there. He said that if the market returns 12% on an annual basis, you can take out 8. Guys, that is so dangerous to do, because what he is not accounting for is that sequence of return risk of what happens if the market goes down next year. Again, we had no idea that the market was going to tank. I mean, that really wasn't that bad this week. But imagine if you're 59 and a half, 60 or 65, and all you have is your 401k. Your money dropped over, I guess, in a way, overnight from Sunday to Monday morning. The market dropped 6-8%. Now, for you to even get back to that balance, a lot of people think that whenever you get a 10% drop in the market, that you need a 10% rate of return in order to get back to where you were previously. That actually is not true. If you experience a 10% drop, you actually need a 20% rate of return just to get back to the balance that you were previously. 20% rate of return is a pretty big ask, right? So when we think about all this, Anthony, I think about retirement income planning. Everything that we've been taught is wrong. And it's wrong because we're only taught to do one thing. We're taught to work really hard. We're taught to, and we know we need to save, which now we get to talk about where do we need to save. And every vehicle is different for people that we can utilize. But the philosophy of it all is saying, okay, we know we just don't need to put all our eggs in one basket and rely on that and rely on the government to be able to sustain us in retirement, when, by the way, that is the time that we're the most vulnerable as humans. As we age, we're going to be very vulnerable. I would rather have the say in what that looks like with math. Again, going back to the logical portion of financial planning. This is the logical side, guys. This is where we think about, okay, what do we need to save and how much do we need to save in order to get from point A to point B? Then we subtract the emotional pieces and we get to that happy medium. But that's what we think about when I think, and I walk through my clients to retirement income planning, is having different asset classes for different reasons. And there's so many other things that we didn't talk about today, because retirement income plan, again, is so much. But just from the high level overview of things, I think that is a good portion to think about when we think about saving for retirement.
Yeah, no, I think this has been great. Like I said from the get-go, and I think you've said too, right? It's not a one size fit all, and it's not, let's just put money in a 401k and put all our hopes in the market, and what it is what it is. And when I run out of money, I run out of money. You've got alternative options there. And the biggest thing is to have a plan, implement the plan, revisit that plan as things change, and make sure you're sticking with it, having that conversation, thinking about your emotions, thinking about, what you want, your long-term goals, things like that, and then having different buckets so that when things don't go the way that you plan, which again, life happens always, you've got some alternative methods and you're not just relying on one bucket.
Yeah, absolutely. Absolutely. Financial planning is not a one size fits all. Be wary of people who come out of the woods when the markets go down to try to push you into buying an insurance product that may not be the right fit at that point in time. I think that is very important, because when you look at the extreme of things, there's so many agents, and I'll leave us with this because I think it's really important, Anthony. There's so many insurance agents out there that really just don't know what they're talking about. They think they know because they have this mentor that they believe in this conspiracy theories that, oh my God, the market's going to go down, everything is rigged, and you need to take money away from the market, you need to go into this insurance product. But the reality is, man, these insurance products, they're not going to be your savior, right? In this case, they are going to be your savior when a lot of things are incorporated into one plan, but just having one thing is not the right thing to do. A lot of people, in the most extreme cases, what I've seen is people being told, hey, the market dropped, like in COVID, negative 35%. They took all of their money out of their 401k. Guess what? They had to pay 10% penalty, and then they paid ordinary income tax on top of that, which if there was a negative 30% loss already with the market, it was another 30% loss on taxes. I mean, I don't know, and maybe my math is wrong in the way I'm thinking about it, but that's 60% of your money just wiped out. Oh, right. And then they're told to put their money into an annuity or put their money into an IUL because hey, there's no market risk here. And man, it is some of the worst things that I've seen. I would tell people to just be very careful of those. And I'm not saying I'm the guy that you need to talk to. I try to educate myself as much as I can, try to get my licenses in the way that I can represent my clients and be a fiduciary to their needs. There's so many great advisors out there. Don't just rely on insurance products and being sold on fear because of what's going on in the market. Because when you have a plan that meets your definition of success, and insurance could be included in that plan, then you're going to be okay. But if you just rely on the fear mongering, the reality is that your probability of success is going to be really, really low, and you're going to be working longer than you want to. Again, not because you want to, but because you need to. And to reach that financial freedom, I think is changing those aspects, those habits, thinking logically and emotional about money, and then also getting other advisors around your table to talk to you about what is the best fit for you.
Yeah, that's something that I preach all the time is, again, don't have 5 different advisors going in 5 different directions. I sell advisory services for my business owners, tax planning meetings, and during those meetings, I always say, let's get these other people on your team on the call so that we can be all moving forward. So yeah, I really agree with that. Get everyone moving forward, get them on the same page, and let's get that plan. Have coaches in place so when these emotions are high, you have someone to fall back to, and you're not making moves out of panic, fear, or greed.
Yeah, yeah, absolutely, man. This has been great. I know we said that we were going to take like 30 to 45 minutes today, but it went a little bit longer. But I think it's again, we didn't even touch on a lot of things. There's so many things that I'm sure we missed, but hopefully the philosophy and the hypotheticals that we showed today could relate to you guys. Again, financial planning and even estate planning and tax planning is not just for the rich, right? It's for everybody. It's inclusive. It's what we do with our money that defines our success, not in a way that, hey, we absolutely need money to be successful, but how do we build a plan around what it means to us and what we want to do in life, and kind of making sure that we have control of our finances. But Anthony, this has been great. Thank you for having me on. Is there anything else that we might have missed?
Well, I think there's a lot to cover. Guys, if you want Andres back or you want a specific topic you want Andres to cover, please comment below. I'm going to have Andres's contact information in the description. So be sure to hit him up, schedule a meeting. If this has been informative, please like and share. Also, I've got a newsletter I just started putting out. So y'all can go to bristertaxlaw.com, go subscribe to that, get updates on all things wealth planning related. Andres, thank you so much for coming on. Hopefully to the audience there, this has been very helpful. We've covered a lot, still got a lot to go. So I look forward to having you on in the future too.
Yeah, absolutely. Anything you guys want to talk about, I'd be more than happy to. I like to say that I'm pretty knowledgeable in the insurance and the investment world. I'm very passionate about what I do. Sometimes maybe a little bit overly passionate, but I really think it's because money is important. It's a tool that we need to use the right way. And there's a lot of people out there that don't have your best interest at heart, and I try my best to keep my clients' interests, and I really do keep my clients' best interests at heart. But just be wary, and I think we can end with the Warren Buffett quote. It's like, when others are fearful, be greedy. When others are greedy, be fearful. And that's true. Everyone has their own agenda. Um, Anthony and I have our own agenda as well, but we try to keep that agenda revolved around others and how we can help just based off of our circumstances that we've lived through. But yeah, no, thank you for having me. This has been fun. I look forward to being on here again.
Yeah. Thanks everyone for listening. Like I said, don't forget to like and subscribe, and then go look us up. Thank you guys.
Thanks.